All right, good afternoon, and thanks for joining the Energy Market Update. A special welcome for all of our channel partners able to make it here today. Very busy week, four stories for U.S. energy, and we saw a kind of mixed reaction from prices, a little bit more muted in the short term, where we saw some of the pop be given up that we saw happen last week for those outside years. But before we get to that, that's me, John Vieira, on the left. We have our trusty legal disclaimer on the right, and we'll be covering the normal agenda of natural gas fundamentals, market news, weather, and then close out with market data. So starting off with the storage report, we had estimates coming into this week of 84 to 89 for an injection. So it looks, and if we take a look at the numbers on the chart in the middle for implied flow and net change, those are all positive numbers. So all parts of the country were injecting. So it looks like we have finally fully gotten out of the withdrawal season. We did have, the injection happened several weeks ago as the first injection, but now it looks like, we'll be doing this until we go back to withdrawal season in the fall going into winter. So again, estimates were 84, 89. It came out an actual number of 92. So a healthy number for storage, a little bit bearish on the day. And overall, really the story has come out of the natural gas for what's right in front of us, which has helped keep a lid on the prices that we're seeing right now in the market. Because right now we're 439 billion cubic feet above last year and 655 billion cubic feet above the 5-year average. And we've been hanging out in the 600s above that 5 average for the past several weeks, giving everyone some comfort. This is a slow story. It's something that's already looking at the winter of 24-25 because it's getting producers to already start to scale back. It does take a while for that to hit the market and for leases to run out and not be renewed. So we could really see a dramatic change in this picture because, approaching the end of winter, we were getting close to the double digits and then really have gained since then. So taking a look at that on a chart, if we look all the way to the right with the green arrow indicating where we are on the blue line, we see that we're above the gray shaded area. So we are well above where the min max has been over the past 5 years and the 5-year average being that dark gray line. So again, when that blue line, if it does start coming down, that puts upward pressure on prices. If it gets close to the gray line or drops below it, that's when we see prices take off like we did during 2022. So if you look to the left side, April, July, October 22 on the left side of the chart, when that was hanging below for storage, remember that was the last time we saw prices really make a huge charge up. For the coming storage report, looking like 50 to 60 BCF being injected in. So again, weather's been very much spring weather, kind of right in the middle, and we haven't seen any late season withdrawals in the past couple weeks. For our channel partners, this is the newer updated version of the natural gas supply and demand. And taking a look at the red arrow, we see the orange line here. And the only difference really is before it kind of went up a little bit, and in this one, it's kind of going down. So forecasts have production dropping a little bit in the short term, and that's kind of what's going to be driving us as we start approaching for the winter, especially for our Northeast markets. But the biggest story is the LNG exports are continuing to grow since we first became an exporter of LNG. And the middle picture goes through June of 2023, and they don't usually publish another official picture, but sometimes using third-party information helps clients really see what's going on. And the forecasts have us possibly doubling in the next several years these LNG exports. And that's from already invested projects, ones with approval and that are moving forward. The smaller graph on the right shows the continuation to this January, and we see that those exports are still continuing to grow. So it is reality. It's lining up with what the forecasts are, unlike some of the stuff we have seen with renewables of very lofty expectations, but not really hitting the goals that we had set forth. So as we're exporting more LNG, and if we're not producing more, we're going to be at a net loss of supply. And where's that going? The National Balancing Point over in the UK, the title transfer facility used for EU pricing, and the Japan-Korean marker over in Asia as some of the major pricing points that people are wondering. It's more expensive around other parts of the world. That's why it's being shipped there, and we're actually seeing the spread blow out on compared to the JKM, so we might be shipping some more to Asia as well. And taking a look at, the most recent confidence interval that we got beginning of April. Again, the upside risk indicated by the black arrows is a lot bigger than the red arrows currently. Now, again, this is only Henry Hub spot pricing, but this is what is lying in front of us. And the further we get out in the future, the probability of moving up in the amount that it could move up continues to grow greater, especially with all the new rules and regulations that are being rolled out. That still we're uncertain if they will stay in place depending on the outcome of the next election. But this is the type of thinking we want to apply to our regional graphs to help clients explain of what's the risk of locking in versus trying to hopefully save a mill or two or a cent or two when you could possibly lose 10 or 20 on the other side. Taking a look at market news, there was a rule coming out almost every day this week, pretty busy, and started with Earth Day on Monday with President Biden rolling out a few new initiatives officially, as well as touting some recent ones. So on Earth Day, he was officially launching the American Climate Corps. Their official statement is to mobilize a new diverse generation, basically towards conservation and climate resilience workers. There are actual no requirements or prior skill sets required for this. So it's not the best and the brightest, it's just anyone that wants to sign up. And the budget continues to grow in coming years with adding another 50,000 additional members by 2031, with over $8 billion in funding, at least $8 billion mandatory annually. So this is a big investment to continue to government hole and now, widen that push for clean energy that they've been undertaking since taking office. Also talking about launching a $7 billion solar panel program for low-income residential, which is another issue because we know we've been talking a lot about the Chinese solar tariff waiver that's been in effect. Are they going to be able to accomplish this with using solar panels from other parts of the world? And lastly, he was touting recently blocking 13 million acres of federal land from oil drilling. So as we can see here, really our takeaway is that the Biden administration is moving full speed ahead. Whether you like it or not, it is happening, and it's making a lot of changes to our supply and demand picture. With the outcome of the next upcoming presidential election unknown, a hybrid strategy is really our strongest product to help hedge against that uncertainty. So reviewing that with clients, whichever they think's materializing more. If they don't know, maybe it's a 50-50 split. If they're leaning towards Democrat winning, maybe it's 75% locks, 25 floating. Republican wins, maybe 25% fixed, 75% floating. Other huge story that just came out today that's been looked at to when they were going to launch it is the EPA just rolled out a new rule that basically could spell the end for coal plants. So they've been going after fossil fuels since he took office. So nothing new here, but really that concentration has been on coal, and we've seen several rules come out since he has taken office. This one though could be the one that puts the nail in the coffin. They're saying that coal plants that exist currently will have to have 90% reductions in their carbon dioxide emissions by 2032 if they're going to plan to run until 2039. So 2032 might seem far away for you as a person, but for planning of generation plans, that is right in view of what's happening right around the corner. So we might see more coal plants forced offline sooner than later, or simply make the decision that if we're going to keep getting attacked, we're just going to move out of this phase of business. So that's much more impactful for our PJM markets and ERCOT, especially PJM, since that's the third largest generation source in there. So we did see a pop in outside years last year. We're going to have to take a look at, those longer term contracts sooner than later. Because as these rules are coming into effect, it's going to make the supply picture a lot more uncertain. While we know that demand is supposed to increase with all this electrification go on, the EV requirements, and the build out of AI. One other thing to note, there is a rule in here about new gas plants that run over 40% of the time would also have to have reductions. The EPA has been touching around and started kind of testing the waters to see about rolling out a similar rule to this on existing gas-fired plants, but have held back. Many out there think that they're just going to hold that until their party, if they do win the election. And that could be very drastic because, again, coal, that's one thing. Natural gas is the leading fuel source in most of all of our markets. And previously on Wednesday this week, we had the Biden administration issue another ban, basically banning fossil fuels in new federal buildings that starts in 2030 or buildings that go under major renovations that start in 2030. And then for leading up to that, it's going to be from 2025, so next year, through 2029, any new builds are going to need to have a 90% decrease in fossil fuel compared to 2003 levels. So this is a pretty dramatic change. They're saying they're leading from the federal level of, what other people should be doing, that push of electrification. We've seen New York State adopt that rule for a lot of new buildings that's based off of law that came out of Berkeley, California, that was actually overturned in the courts. This was a rule that Obama tried to pass during his time in office that was blocked originally. So we're uncertain of the outcome, again, if these rules are going to stick, because the proper legislative process of coming from Congress versus out of an agency under the executive branch continues to happen. We've seen several get shot down at the Supreme Court or other courts. So keeping an eye on this, but the real takeaway with all these 3 new rules coming out is we know that these rules and regulations continue to come out at a very fast pace, affecting our energy. So we need to make sure that clients are well informed so they can weigh the risks and find a best strategy for themselves. Moving to some bigger global issues, looking at Israel, that started with a terrorist group attacking Israel and is now widened into a much wider web around the world, which was the concern that we had from the beginning of if the fighting's there, because we're looking strictly through an energy price lens of supply and demand. The beginning, we were losing some supply in the area because of the attacks. Since then, the biggest story really has been the rerouting of shipping because of the surrounding bodies of water and the attacks going on from various different groups from all different parts of the world versus who's around the area. And recently, we had Iran directly attack Israel, Israel responding to that attack. And over the past week, we have the U.S. passing a new aid package. And that includes Iran oil sanctions. Now, this is important because now it starts bringing China and Russia into this side of the story, because China and Russia are top buyers of Iranian crude, with China buying between 80 to 90% of Iranian exports. So from one point is, if China isn't going to be able to get the oil from Iran or energy supplies, where are they going to get from? So that helps to further destabilize the global picture. The other question is, does President Biden, because he has the option whether to enforce these sanctions and if countries will even follow them. So we have that deteriorating relationship with China right now that we need really for this clean energy push. So how hard are we going to push them for that? And how hard is he going to push on this oil, which would drive up world oil prices ahead of an election? So a lot still seems uncertain there, but something to keep an eye on as the conflict continues to grow. Taking a look at Ukraine and Russia, a lot of money going to the Ukraine after a lot of hand-wringing going back and forth, different countries around the world. We have Biden signing a $95 billion package. Now that package touches on Ukraine, Israel, and Taiwan, which are kind of at the heart of all these stories, right? We just covered Israel, China being next with the fight about Taiwan, but the package allows for $1 billion to be released immediately to Ukraine and a total of $61 billion going there. The UK just really upped their amount. They're donating billions of dollars to the country as well. So it does not, again, look like this is coming to a resolution anytime soon. Unfortunately, the nuclear talk is popping up again because Russia, according to Belarus, has completed shipping nuclear arms to Belarus. And in reaction to that, Poland is now saying and has invited other parts of NATO to come to their country to meet, and they're talking about stationing NATO nuclear arms in Poland. So again, the escalation of arms continues. Hopefully nothing bad happens, and we also have in the middle picture, right, the nuclear plant that's still sitting out there. We haven't heard news on that, but any of those things go wrong, people are thinking about nuclear for the future. That could really throw a wrench in that plan. And lastly, one of the really big stories with all the aid that we've been giving to the Ukraine, a lot of their recent drone operations are going against what the U.S. has been asking them to do, which is don't attack the energy infrastructure over in Russia, because it's going to destabilize the global markets even further. So that's come from several public officials in the Biden administration right now, but Ukraine has continued to move forward. So that could be a picture directly affecting the energy picture in the world if they keep blowing up energy sites that you see pictured in the bottom left, and that happened just yesterday. Taking a look over at China and our kind of deteriorating relationship as we go by date. The South China Sea and Taiwan have been very big sticking points for the relationship. And we have June coming around the corner for the solar panel waiver that was put in place in June of 2022 after the entire solar industry pretty much came to a standstill in February of 22 when the Commerce Department found 4 Southeast Asian countries of skirting Chinese tariffs by basically rubber stamping Chinese products and parts to send them to the US. Since then, we've talked about even India companies trying to get panels into the US that were, again, coming from China. And there's been a lot of fight between the US and China about who can receive taxpayer subsidies for this money or not, what percentage China can have interest in them. So this clean energy push is, again, changing us from energy independence to relying on foreign countries, and some of them we don't have the warmest relationships with at the time being. And on that, pretty troubling twist over the past week, because the largest oil company in the world in Saudi Arabia, Saudi Aramco, comes out and says, we're in support of China in this ongoing EV and solar panel fight between basically the US, the West versus China. We talked about a couple weeks ago, Janet Yellen trying to go to China, asking them not to produce as much. We have China bringing us to the World Trade Organization, saying that we're being unfair and breaking the rules, which objectively they have a reasonable case. So again, that's where it's deteriorating there. The bright lines still have been Taiwan and the South China Sea, and the fight about technology as we move forward towards this AI revolution. That's why Taiwan really comes in key. So fighting about computer chips last year during 2023, they cut off a lot of supplies for that in August of 23. And we started fighting about the energy, and then we saw some energy products with graphene being cut off in early December, and some technology associated with wind turbines getting cut off in late December. So do they cut off anything else in the future months? When they made these rules, they happened very quickly. So that could leave us in a very contentious place if we don't have another plan, because economically we cannot build things here for the same price with the minimum wage and healthcare and other benefits. Moving over to renewables, at least this is an update for the near-term forecast. So out in the future, yes, we might be bringing more online for generation, but for 24 going to 25, if we take a look at solar and wind, it is increasing, but not very dramatically. It's not hockey sticking going straight up, really making the gains a lot of the forecasts had hoped that we would get to. And then also just, again, reality versus headlines out there, just so we can make sure clients fully understand what the supply and demand picture is going forward. If we take a look at ICE in New England, NYISO, PJM, MISO, and ERCOT, not too much of a change year over year, a little bit up, a little bit down. And those are the smaller numbers right next to the red or green triangles. And then also in this type of market, remember, summer is around the corner, capacity season for our PJM and ICE in New England markets. Capacity pass-through still being a very strong option in PJM and ICE in New England, especially with the new rules allowing for subsidized assets to be in the market. And for PJM, those new rules started below the yellow line, and we can see since then the prices have continued to clear lower. We're still waiting to see what the next auction does. That was already kicked back, was supposed to be held last June, canceled a few days before, supposed to be held this June for coming 25-26 capacity year for PJM. Always could get pushed back again, but looks like this will move forward. Helps clients save looking at capacity if the market comes down, and they can also manage their cap tag. Again, we have a free peak notification program that they move down their usage a couple hours during the year to save on the entire next year. So when they start seeing the dollars and cents, they're more willing to maybe do a couple changes on a couple afternoons during the summer. Take a look at ICE in New England for capacity. We know that FCA 18 cleared a little bit higher than previous, but still down low where it's being priced. No crazy pop there. Big news out of ICE in New England is that FCA 19 that was going to be held February 2025, because ICE in New England has been on track where PJM continues to make new rules as the states fight between about how green and how many measures they can include in the capacity market. ICE in New England is now thinking we wanted to push back this from 25 to 26. And now for those future ones, we might totally change the capacity market. There looks to be a vote coming soon, but it's really so that they can try to incorporate all these rules and uncertainties about offshore wind, maybe or maybe not being built. If it's built by, a certain year is pushed back to, how that's going to impact if they bid into the capacity market, because it would leave the market short. Therefore, they want to have a more readjustment instead of just a 3-year forward, which was built to really dictate for fossil fuel type generation that either needs to be built and brought online or not. Taking a look at weather. So this was the March release of May to July, and we can see likely to, leaning above to a little bit of likely, with likely really being Texas. And the April release really showing that most of the Northeast likely above hot summer, most of Texas hot summer expected for the start as we move from spring into summer. And the forecast for June to August looks hot. We're seeing that for the Northeast and for Texas. So it looks like we are going to have a hot summer hanging around. So really, before some of those temperatures start getting around and you start seeing the LMP index prices pop, good time to get some of that load locked in. So for right now, most forecasts have El Nino sticking around, which usually leans to warm and dry. We had El Nino this past winter, and we had one of the warmest winters on record. We didn't really have that Arctic blocking materialize, and that's only forecast in the short term. So we're looking at long-term indicators. El Nino conditions persisting through the summer is going to likely lead to a hotter, drier summer. So hotter temperatures, usually consuming more cooling demand, driving up prices. So we might be walking into a 1-2 punch, hot summer, and then possibly leaving El Nino for La Nina by the end of summer into early winter. So sometime maybe during end of August, fall, early December. And if that happens, we could be in for, hot to cold without really a lot of time for, especially generation plants to do maintenance in between if they're trying to capture it. So more susceptible for price spikes if any of those go offline with storms. So keep an eye on that as we move forward. Temperatures for the next 7 days, very much spring weather. Nothing really surprising here. Nothing dropping into the freezing temps in the Northeast. While down in Texas, no temperatures really hitting the 90s or hundreds just yet. But those temperatures could be coming soon, and when they do, likely going to add a little bit of bullish pressure on prices. Now we'll take a look at the market data for ICE in New England. So the balance of the year ended up being pretty flat. Actually, the May-June came off a little bit while the winter kind of offset that. So ICE in New England balance of the year, and we're looking at May to December, was pretty flat week to week, still pretty close to the 52-week low, moving up. And the common theme we're going to see in a lot of these markets is they're kind of off the mid to late February lows. They're starting to make pushes up. Everything from the gas storage point seems okay, but more of where we're going forward starting to get a little bit more excitable. Taking a look at ICE New England for calendar year 25, as we see those outside years making a bigger jump as we move forward. So it was actually off 1 mil week to week, but since those mid-February to late February lows, really kind of moving up, getting close to that 52-week average. Now this is also happening because the old 52-week highs are disappearing. So using the long-term graph to show you, how much higher this could run from here, especially since, new administration has taken over with the clean and green energy push. We had the Russia-Ukraine global conflict kick off, and now we have a lot more going on. It's continuing to change the supply and demand picture. Taking a look at Algonquin for balance of this year, May to December, pretty flat week to week, still near the 52-week low. So 24 really still hasn't been excited for Algonquin, but 25 we're starting to see move up. It's up a half cent week to week, still a little closer to the 52-week low, but getting close to that midpoint. So still a lot of these markets in reasonable points to lock in, especially when you blow the 52-week average with what we have ahead of us. PJM, similar story, not too much action. May and June coming off a little bit, the winter months growing a little bit for balance at 24. And for May, December balance, pretty flat week to week. When I say pretty flat, that's less than a quarter mil for electricity, less than a quarter cent for gas. But it's still been hanging out near that 52-week average. It's a little bit below right now. But this average will be moving as these highs start disappearing from the left side. Taking a look at PGM calendar year 25 was off 1 mil week to week. Still a little bit above that 52-week average. It made it really push higher. It was getting close to the midpoint between the average and high. It's come off a little bit. Good spot to pick something up. And taking a look at PJM gas using TETCO M3 was pretty flat week to week, still a little closer to the 52-week low. Again, the common story is they kind of crashed down during February. They're starting to rebound, and we see the same with calendar year 25 being pretty flat week to week, but continuing to move up slowly. Taking a look at ERCOT, focus has been on the summer. July and August have continued to have attention. Volatile, continue to move up from the lows that we had seen. And we have ERCOT balance of the year, May to December, up 1.5 mil week to week, establishing the new 52-week high yesterday. Again, still has room to run when we look at the long-term graph, and stories out there that the load is going to be increasing, and some have it hitting 40,000 megawatts by 2030. So between now and then, we're adding that amount to the grid. We had records at 80,000 and change last year. How much higher is it going to get in ERCOT with all the changes going on, with all the data centers and AI and EVs if they are added? And taking a look at ERCOT Houston calendar year 25, up 1 mil week to week, establishing the new 52-week high on Monday. So again, still continuing to move up. Very worried about this summer. So sooner those prices start coming up, heat sets in, they could get a lot higher from here. Taking a look at Houston Chip Channel, up 0.5 cent week to week, still close to that 52-week low for balance. And calendar year 25, up 0.5 cent week to week, still closer to the 52-week low, but again, coming off those lows. Let's not wait necessarily too long. Hybrid strategy, at least lock in maybe 20-25%. We know Henry Hub, Houston Chip Channel, very similar because they're very close to each other. It's up 0.5 cent week to week. The big story really is for ICE New England PGM. If we take a look at the left side of the chart versus the right, it's a lot closer together to the gray line, and the red actually is below for PGM, but that's if you use only the same amount every hour of the year. Most people are using more during the winter and summer than they do in the shoulder seasons. But great time to lock in compared to what you see on the left of the screen when they're further apart, and that's what it is when you lock in your basis. You're locking in that compression, and you're leaving up to chance if the Henry Hub moves up or down. So I have Houston Chip Channel on this graph, although it's not as big of a product in Texas, but PGM definitely, some of that advantage might be disappearing because you see through most of this chart, red is over the gray, and that is commonly how it travels. But as of late, the discount that we've seen is starting to get closer. So could that be disappearing? So a good time to lock in at least the fixed adder for gas and PJM. Taking a look going out into the future for ICE in New England, we had 25 off a mil week to week, 26 off 2 mils. Outer years came off and basically give up the pop that was between 2 to 5 mils that we had last week on some of those outside years. And that's why it's important that we take a look at those longer term contracts with clients sooner than later, because we're starting to see these pops starting to materialize more often in the outside years. And once they stop falling, you're going to be out of luck to buy a dip. And then looking at the long-term graph, these have been one of the more effective of helping clients understand where prices are now compared to where they last bought. So looking at 24, 25, 26, 27, and you can see the 24 line stops because then the calendar year 2024 began and the balance of the year starts trading. So it would not be apples to apples to keep that price, especially in the Northeast. When you take January and February off the board, the most expensive months in the year, this would look a lot lower. And also, as we go through them, you're going to see this line on some charts drop a lot lower. And that's only when things are right in front of your face and you know exactly what's going to happen. Based on where things have traded in the past, they usually don't fall that down. So with the client, you can mark, okay, this is the last time you bought. This is where prices are now. Let's take a look at the price difference, at least to give them an idea of why prices might be higher than now. And then also looking at where prices could go from here, whether you want to use 24 as the top or 25 from where it is now versus the low of maybe back here when Biden takes office, rules start actually taking effect months after he's in, and then really Russia-Ukraine takes off. Taking a look at PGM going out in the future, 25 off a mil. Outer years were off 2 to 6 mils. So we had a big pop in the outside years last week. They're back down today. with the announcement of the story we just brought out about coal, these things might be heading right back up. So again, taking a look, especially in PJM with these stories out there about those outside years. Now, the next presidential election could change that. So maybe not lock in the whole thing, maybe do 50%. And this is the pop we were talking about. We saw last week with those outside years, 26, 27 for PJM. They're still on the way up, but they've taken a little steam off, at least for where they were as of close yesterday. Lastly, for markets, taking a look at ERCOT, Houston futures, 25 up a mil, out of years up around the same. There is maybe a little bit of separation on those outside years depending on who's pricing it, but they have been moving very closely together by comparison to our other markets. So a lot of our points generally stay the same from where the market has been currently. We want to manage the risk of how high or low the market can go from here. Yes, it can slide a little bit lower. There's a lot more reasons it can slide higher at the time being, and it could go to a lot higher level. Evaluating longer terms is key now with some of these stories out there. So highlighting that one this week, especially with the movements we've seen of recent. And if these rules do hold up in the courts and they are going to move forward and Democrats stay in office, likely really drive up those outside years. So taking a look at those sooner than later with clients. Because sometimes when they're seeing those 24, 36 months, they look a lot more expensive because currently they are, but they can run up even further because right in front of us has been relatively very cheap. Very important thing we're running into in the Northeast is if you look at a summer rate, and the bar charts for the months are very important for this. If you're looking at like a 6-month summer rate that doesn't include the winter, that price obviously is going to be a lot lower than a 12-month rate because it doesn't include the most expensive months of the year. So just making sure clients are able to understand that and see the value that they're getting if all the markets are towards the low. And then we have ERCOT electricity around the 52-week highs, PJM electricity starting to be around the 52-week average with 24 just below and 25 a little above. And most of all of our other markets basically moving off the mid to late February lows. So with a likely hot forecasted summer coming, might be relative low prices disappearing sooner than later to lock something in. We keep seeing today with the 3 stories, I mean, the whole government approach to clean and green energy continues to go full speed ahead and is not stopping. So that could cause a lot of issues depending if we're shutting down fossil fuels, we're not being able to bring on supply, because we've talked a lot about a lot of the setbacks with offshore wind that we've had recently and the issue with solar tariffs becoming from products in China. And lastly, talking about the other parts of the bill. I mean, your fixed adder takes up a big portion of people's bill. It's worth talking about those RECs and talking about capacity options for your client.